What is due diligence as part of the equity funding process? Well, generally, due diligence is where the investors have the opportunity to review all relevant material information about the company. This generally consists of operational records, financial records and statements, and then any legal records, particularly corporate governance things pertaining to the company. Now, the objective here is to make certain that everything represented by the startup to the investors is accurate to the best of their understanding and ability. The startup venture has to comply with the Securities Act of 1933, which means disclosing all material information. So the process by which this happens is they generally create an electronic data room and they pull in all material information. Well, that begins with all operational records, everything that goes into the value proposition and how delivery is made. These are contracts, these are prior dealings and relationships with third parties. This is possession of assets, all of these things. They'll also look at the financial records, which are your tax returns, which are your financial statements that have been prepared along. These may even include specific evidence of invoices paid, proof of payments received, or revenue structure, things like that. There have been so many scenarios where fraud has been perpetuated by individuals who claimed a certain amount of revenue or a certain degree of cost, and that was not accurate. So again, they'll disclose all the financial records, and then all the legal records, which again are existing contracts or obligations, intellectual property agreements, corporate governance procedures to make sure all of the procedures and steps for organization and all decisions made within the company were appropriately taken. That is, you've got director approval and board approval, and then the officers in doing stuff were authorized to do so, and even if they weren't authorized, that it was later acknowledged and accepted or ratified by the board. So this is what due diligence is, and this is generally the process by which it happens. So once you've executed a term sheet, you believe you have everything in place to construct the stock purchase agreement and all the provisions worked out, the parties will open up the data room or the due diligence room, load up all the documents for review. The investors will hire accountants and legal advisors to help them review these records, and they go through it and identify any red flags or things outstanding that they need to review. Oftentimes this ends as well with a legal opinion from the legal advisor for the investors that everything is operationally sound in terms of corporate governance. And then from there, the parties are satisfied. They can move on to execution of the stock purchase agreement and, once again, approval by the board of directors and shareholders of the funding transaction.